WTI crude oil futures rose toward $71 per barrel on Friday, advancing for the third consecutive session, as market attention shifted back to the Middle East conflict. This change was prompted by a report suggesting that Iran may be preparing to launch an attack on Israel from Iraqi territory in the coming days, with media sources indicating that the anticipated attack could involve drones and ballistic missiles. Investors remained on edge, especially following Israel's military chief's warning that a very hard strike on Iran would follow any further missile attacks. Additionally, oil prices were bolstered by expectations that OPEC might postpone the planned increase in oil production scheduled for December by a month or longer. If WTI oil stays above the $70 level, it will head towards the resistance at $72. U.S. nat gas prices are on a downward trend Thursday, hitting a new low for October in early trading and approaching levels not seen since late August. This decline is largely fueled by bearish weather forecasts, lackluster performance in the broader energy sector, and the prospect of higher-than-expected storage levels. A primary driver behind the price drop is the shift in U.S. weather projections, which now indicate warmer-than-normal conditions, likely keeping heating demand low through mid-November. From October 31 to November 6, cooler weather systems are expected to bring temperatures ranging from the 40s to 60s Fahrenheit across parts of the western and central U.S. Meanwhile, the southern and eastern regions will experience milder temperatures, with highs in the 60s to 80s, and even reaching the 90s in some areas. Altogether, these conditions suggest only modest natural gas demand for the week. Weather analysts note that the American Weather Model has recently reduced its heating degree day forecast by 11 degrees, indicating a decline in expected natural gas demand. The mild outlook and unseasonably warm temperatures across much of the country point to limited short-term demand, placing further pressure on prices. Today's EIA weekly storage report also adds to the downward momentum, showing an injection of 78 billion cubic feet. While this is slightly below the market's forecast range of 79 to 85 billion cubic feet, it is still well above the seasonal average of 67 billion cubic feet, reflecting a supply surplus as mild weather has curbed recent demand. With warmer forecasts, below-average demand, and storage injections surpassing seasonal norms, the short-term outlook for U.S. natural gas prices remains bearish. Unless colder weather patterns emerge, a significant price rebound seems unlikely as supply continues to outpace demand. From a technical perspective, the market has fallen below the 50-day moving average support at $2.38, turning this level into a significant resistance point. Prices have struggled to stay above this threshold, diminishing the chances of a recovery without a strong bullish catalyst, such as impactful geopolitical news from Iran. Without such drivers, prices may continue to drift downward toward primary support near $2.30, which is likely to hold unless colder weather forecasts create upward pressure, pushing prices to challenge the $2.40 resistance level. The $2.30 level also offers a favorable entry point as we approach peak demand season, where an influx of bullish traders could step in, potentially sparking upward momentum. Please like, subscribe, and comment to support the channel. See you in the next one.